Right now, Bitfarms, ticker BITF, is trading at $4.11.5, and it's up about 1.35% in live intraday action. The stock has been bouncing between a low of $3.97 and a high of $4.19 so far today. And let's be honest, the immediate gut-level expectation for just about everyone watching this name is that it's a simple, levered bet on Bitcoin. You see Bitcoin move, you expect BITF to move more. But if that's the only way you're looking at this company, you are missing the single biggest development in its history, one that is happening right now and completely changes the investment thesis. The reality is that Bitfarms is in the middle of a complex, expensive, and foundational pivot away from just being a Bitcoin miner and toward becoming a US-based energy and high-performance computing infrastructure company. The old story is dead. This is something new. Of course, the common ground we all stand on is that Bitcoin miners are a proxy for Bitcoin. When the underlying asset, which is consolidating in the low $110,000 range, shows strength, these mining stocks are supposed to provide high beta exposure. You buy them on your Robinhood app or through Fidelity investments to get that amplified upside. We've seen it time and again. It's the simple story that gets sold to everyone, from self-investing beginners to those using Schwab intelligent portfolios for automated allocations. The expectation is set. Bitcoin goes up, your mining investment goes up even more. But the market has been telling us that this expectation is flawed. The reality for Bitfarms is that the stock's recent painful volatility hasn't just been about the price of Bitcoin. In fact, the stock took a major hit in mid-October, a sharp, punishing drop that had investors checking their SoFi Invest accounts in a panic. Why? It wasn't because Bitcoin collapsed. It was because Bitfarms announced it was raising a staggering amount of capital, first announcing $300 million, then upsizing it to $500 million, and finally closing on nearly $588 million in convertible senior notes. That single event tells you more about the reality of this company than the daily Bitcoin chart ever could. The market had to absorb the fact that this company is taking on an enormous pile of debt. This isn't just a simple miner humming along. This is a company in the middle of a massive, cash-hungry transformation. And this is where the story gets fascinating. Bitfarms is executing a two-part strategic maneuver that is a complete shift in its corporate identity. First, it just closed on the acquisition of Stronghold Digital Mining. This is a transformative M&A deal, the largest between two public miners in the industry's history. This move brings Bitfarms significant assets and, most importantly, a massive foothold in the United States. Simultaneously, the company sold its 200-megawatt Iguazu data center in Paraguay. Think about that. They are actively divesting from foreign operations to recenter their entire portfolio in the U.S. The company has been explicit about this, stating they expect greater yields per megawatt and, critically, a reduced average cost of power by focusing on the U.S. market. This isn't a minor tweak. It's a geographic and strategic overhaul. But here is the part that truly shatters the simple miner expectation. That $500 million plus capital raise isn't just for buying new miners. Bitfarms is aggressively pushing into high-performance computing, or HPC, and artificial intelligence infrastructure. They have appointed a new senior vice president of HPC and a new SVP of infrastructure. They are actively evaluating their new U.S. sites, specifically 3 in Pennsylvania, for conversion to HPC data centers. Initial studies are already in, confirming these sites are well suited for this pivot, located near other data centers and peering hubs, with the necessary power and fiber. This changes everything. This company is no longer just competing with other miners. It's now stepping into the ring to compete for AI and HPC workloads. This is a strategy to diversify away from total reliance on Bitcoin mining. It's a move that attempts to capture some of the secular tailwind that has sent Nvidia stock into the stratosphere. It's a bet that they can leverage their core competency, building and managing large-scale, power-intensive data centers, for a new and potentially more lucrative customer base. This pivot is absolutely necessary when you look at the reality of their recent financials. The last reported quarter, Q2 2025, showed a tale of two cities. Revenue was up an impressive 87% year over year. That's the expectation part. But the reality part was a net loss of $28.8 million, and more alarmingly, cash from operations was a negative $74.5 million. The company was burning cash, and its total liabilities had ballooned by 166% year over year. This financial pressure is the context for the entire strategic shift. They had to make a big move. They had to raise that massive convertible note offering. The reality is that the old model was becoming incredibly capital-intensive and exposed, and management decided on a high-stakes pivot rather than just riding the Bitcoin wave. This makes BITF a much more complex holding than, say, a simple Fidelity mutual fund tracking the tech sector, or just holding Apple stock in a Fidelity IRA. This is a special situation, a turnaround play, and a speculative bet on a new business model all rolled into one. Whether you are a retail trader using the Robinhood app or a sophisticated investor managing an individual brokerage account with Interactive Brokers, you must understand this. The company is spending heavily, and its debt load is now a primary factor in its valuation. The recent stock movement reflects this tension. The daily swings are no longer just about algorithms keying off the price of Bitcoin. They are about arbitrage traders managing the convertible note, about institutional desks trying to model the potential dilution from those notes, and about analysts attempting to value a non-existent HPC business. The volume has been high, showing just how much churning is happening under the surface as long-term Bitcoin bulls perhaps sell to new investors who are betting on the AI infrastructure angle. Operationally, on the mining front, the company is still executing. Its latest update for March 2025 showed its operational hash rate grew 21% month over month to 19.5 exahash, and its fleet efficiency hit its Q2 target 3 months ahead of schedule. This is crucial. The core mining business is performing well, and it needs to be a healthy cash flow engine to fund this ambitious and expensive new venture. If the mining side falters, the entire strategy could be in jeopardy. So, what is Bitfarms? For years, it was a global Bitcoin mining company. It built, owned, and operated mining farms in Canada, the US, Paraguay, and Argentina, priding itself on vertical integration and in-house management. That was the old story. The new story, the one that is unfolding right now, is that of a North American energy and compute infrastructure company. It's a company that used to be a pure-play Bitcoin miner, but is now using its expertise in energy and data center operations to enter the HPC AI market. It's a bold, costly, and risky bet. Based on this major pivot, comment below. Are you investing in Bitfarms for Bitcoin or for their new AI HPC strategy? I'm genuinely curious to see what the consensus is. This pivot changes the entire risk-to-reward profile. Looking ahead, the future outlook is now split along two very different paths. The most important near-term catalyst is the upcoming Q3 2025 earnings conference call scheduled for November 13th, 2025. This will be the first time management will have to speak in depth to all these new moving parts: the Stronghold acquisition, the Paraguay sale, the massive debt, and the tangible progress on the HPC AI front. This call is a must-watch for anyone with an investment in the company. The bull case, where reality could exceed expectation, is that this works. The company successfully integrates the Stronghold assets, their U.S. power costs drop significantly, and the mining operation becomes a cash flow machine. They then use that cash flow plus the capital raised to rapidly build out their HPC AI division, landing their first major clients in 2026. If this happens, the market will be forced to re-rate the stock, moving it from a simple Bitcoin miner multiple to a much higher AI infrastructure multiple, something closer to the valuation seen in the data center and cloud adjacent space. This is the grand slam scenario. The bear case, however, is equally potent. Here, the reality falls short of the expectation. The integration of Stronghold proves difficult and costly. The debt load, now over $500 million, becomes an anchor, with interest payments eating into the mining profits. The pivot to AI is too little too late, in a field that is brutally competitive, dominated by giants. In this scenario, the company